Good morning, welcome to the market view for Thursday, the 22nd of May 2014. Just before we get into the GBP, just bring you up to date with the Dow videos. Yesterday I started compiling all of the material for the implied. I was hoping to record it, but actually what happened was I was able to go back and find a lot of the old material with regards to the implied volatility dating back to 1993 when I first uncovered this. So instead of just throwing out a 5-minute video on the implied volatility saying, look, here it is, this is what it is, I thought I would show you the actual journey of how I actually came across this, our visits to America, to different brokers and so on and so forth. Fascinating story. So I'm going to put all of that together and compile all of it, and also being invited out to Futures Magazine conferences and talking to some of the world's top traders about this particular thing, articles in newspapers and things as well. So I found all this material. So what I'm going to do is to compile it all into the video so you can see the power of this and how it was endorsed and is endorsed by the industry. And also I managed to find some recordings back from 2007 prior to the credit crunch where we actually used the implied volatility to forecast the drop in the stock markets at that time as well. And also found a live trade example on the FTSE as well of some 80 points, going back to 2007, which is 7 years ago. So just to show you that this is still consistent, that it works, and by having all of this other background information to it, then you will be able to understand it more, why it works. And also the good news is that we're just in the process of one of these major setups where we're going to see a decent correction in the Dow as well. There's only one variable, which I will discuss, that has changed since 2007 as far as this is concerned. But that doesn't detract from the fact that the Dow at the moment is setting itself up for a decent correction. And all things being equal, I am going to try and get it all together. But like I say, there is a slight delay. And that's because I want you to have all of the information with regards to this because of the power of it. So please indulge me, bear with me, and I will endeavour to get it out to you as soon as possible. You'll certainly have it by the weekend, that I promise you. But there is a bit to edit and pull all of the material together. So I just ask that you just have patience with me, and honestly, it will be worth it. I can assure you. It was quite a nostalgic trip going back yesterday and finding all of this material. That will, as I say, give you the full impact of how powerful this tool will be that I'm going to provide for you. Right, so let's move on to today. Let me get this out of the way so I can get on with recording and compiling the rest of the stuff on the implied volatility for you. So yesterday we had the news out, and we saw the market rise. This was the Bank of England report on interest rates, and for some unknown reason they decided to move. Normally it doesn't, but like I said yesterday, you're perhaps better off out of the market. And we saw the market move up. There's the 9:30 bar, and then there's the news, and then the market traded sideways until we had this potential sell signal. The market moved lower all afternoon, and of course we had Yellen speaking yesterday evening, 1900. You can see that bar complete, and then the FOMC release there. So let's just take a look at the first signal. We can see that we got down to, I'll just use the pip retracement tool there, we got all the way down towards the 19 pips there for prior to 7 p.m. when the FOMC announcement came out. And worst case scenario, you should pick up 10 pips there at least, if not a few more. We then had the buy signal appear after Yellen spoke, and again we've traded back up towards the let's have a look, 169 level, I think that is for the market. 168, yep, 169, and you can see the market then stopping and then starting to drift sideways. So a few pips there as well. Again, the maximum available in this after half an hour of the FOMC being digested in the market is 16 pips there. So there were pips on the table, modest no doubt about that. But yeah, it was slow grinding up and down as far as the market was concerned yesterday. So let's have a look at the daily chart and see what we can glean from what the market did yesterday. Well, I'll remove a few of these lines that we placed in yesterday just to tidy the chart up. We've gone through the fib lines that we drew there, so we can remove those as well. And what we need to do is to, as the market went through the other lines, we need to move back a bit and just see where the market stopped at. And funny enough, we take this high to the left, and the reason I chose this one is because if I draw a line across here, I can already see with just by eyeballing the chart that I know that if I'm so close to the high of this bar, it's already going to be through the 76%. So I'm just going to draw that in for you actually, so you can see that I'm not making it up. And there you go, you can see it's already through there. It's coming back through now, but yesterday afternoon the market went through this profit target. So all you would have needed to have done is just gone to the next high, drawn in, and then you get the 169.16. We saw the market go back to 169 after Yellen had spoke at 7 p.m. last night. So that's the upside. The potential on the downside is going to be really from here to here. So that's about 168.46. That's 50 pips from there down to the 62, and then 168.29 for the next downside target. So we'll leave those in at the moment. And of course, on the upside, just in case the market goes through the 169 level, we can use the small one there down to the low, and we can see, we just get rid of the 62 there. We can see there's a few more pips to the upside at 169.24, and then there's nothing higher than this bar. So from the high to here, we've got the final 76% target, and a breakthrough this would require the market to go through and head towards the recent high, which would be 169.95. So 170 is again back to that sort of psychological level that we saw back in 2009. In the news today, we've got some French news out at 8 a.m. and then we've got the second estimate for the GDP quarter figures. They're saying that they're forecast as the same as previous. It's an interesting one. That's at 9:30. It's a bit of a difficult one. Normally I wouldn't bother, but because they've been manipulating the figures, and that's not me just saying that. I think manipulation maybe is the right word, but they've revised on the way that they actually calculate them. There's an article in the business section of the Telegraph a few weeks ago that was sent to me, and the government now are going to take into account, but I don't think it's until September, pension forecasts, which is bizarre. So any forecasted pensions that are going to be received are going to be lumped into the GDP figures just to manipulate them, make it look like there's a genuine recovery underway, even though the debt is still increasing. So it's probably wise to be out on this one because of the manipulation in the background of the figures, or the potential of it anyway. That's a certain fact. Weekly jobless claims for the US, not too much of a problem. It's the the non-farm payroll ones that are generally the problem for the market. You don't want to be in with those ones. The weekly figures are not too bad, and then existing home sales at 3 p.m. and they're forecast to be higher as well by some 200,000 by the looks of things there. So I wouldn't be too concerned about that particular one. It's more the inflation, interest rate, that type of news, FOMC, that bothers me more than home sales. It's not something that would drive the market 300 or 400 points at all. Right, well, that's it from me. I'm going to go and grind on with compiling the rest of the material for the implied volatility video. Like I say, do accept my apology for the slight delay, but like I say, it will be well worth it, because there's going to be a lot more information there, and actually the history of how I actually uncovered this and how you can apply it even in today's market, and also examples of how I applied it in the past and forewarned, and where lots of money was made from the actual fall in the markets, and also on the opposite side for the market to come back as well. But more on that anon. And all things being equal, see you tomorrow. And as ever, thank you for your support and also for watching.